Question 1. A policyholder has a homeowner's insurance policy with a $1,000 deductible and a coverage limit of $200,000 for property damage. After a fire, the policyholder suffers $50,000 in damages. How much will the insurance company pay? A. $50,000. B. $51,000. C. $49,000. D. $200,000. Answer: C. $49,000. Explanation: the deductible amount of $1,000 is subtracted from the total damages of $50,000, so the insurer will only pay $49,000. This follows the principle of indemnity, where the policyholder is not entitled to receive more than the actual loss suffered, which in this case is $50,000 minus the deductible. Question 2. Scenario-based. Mr. Carter is a life insurance agent in Nevada and recently sold a life insurance policy to a client, Mr. Phillips. Mr. Phillips misrepresented his age on the application. The policy has been in force for 2 years. When Mr. Phillips dies, what action should the insurer take regarding the death benefit payout? A. Pay the full death benefit as per the original policy. B. Reduce the death benefit based on the actual age of Mr. Phillips. C. Cancel the policy immediately and return the premiums. D. Deny the death benefit payout entirely. Answer: B. Reduce the death benefit based on the actual age of Mr. Phillips. Explanation: under Nevada insurance law, misrepresentation of age on a life insurance application is grounds for modifying the death benefit. The insurer is allowed to adjust the death benefit based on the true age of the insured, which may result in a reduced payout. This follows the principle of contestability, which gives the insurer the right to adjust the policy if material misrepresentations are found, typically within the first 2 years. Question 3. Which of the following is an example of an unfair trade practice under Nevada Insurance Code? A. An insurance company offering a 10% premium discount for bundling auto and homeowners insurance policies. B. An agent providing a client with misleading or incomplete information about a policy's coverage. C. An insurer offering coverage for earthquake damage as an endorsement to a standard homeowners policy. D. A producer recommending a client purchase a policy that suits the client's needs and budget. Answer: B. An agent providing a client with misleading or incomplete information about a policy's coverage. Explanation: under Nevada's insurance code, unfair trade practices include misrepresentation of insurance products or providing misleading or incomplete information about a policy's coverage. This violates the consumer protection laws aimed at ensuring that insurance consumers are well informed and can make decisions based on accurate information. The other options describe permissible practices such as offering discounts or adding endorsements for specific coverage options. Question 4. Which of the following statements is correct about the Nevada Insurance Guarantee Association? A. The Nevada Insurance Guarantee Association covers claims only for health insurance policies. B. The Nevada Insurance Guarantee Association protects policyholders if an insurer becomes insolvent up to certain limits. C. The Nevada Insurance Guarantee Association is a government agency that underwrites insurance policies. D. The Nevada Insurance Guarantee Association only applies to life insurance policies. Answer: B. The Nevada Insurance Guarantee Association protects policyholders if an insurer becomes insolvent up to certain limits. Explanation: the Nevada Insurance Guarantee Association is designed to protect policyholders in the event their insurer becomes insolvent. It provides coverage for claims up to specific limits based on the type of insurance. It is a state-mandated program and does not act as an insurer itself, nor is it limited to health or life insurance policies only. Therefore, it ensures policyholders' rights to receive compensation even when their insurer is unable to pay due to insolvency. Question 5. When underwriting a homeowner's insurance policy in Nevada, an insurance company will primarily evaluate which of the following factors? A. The applicant's credit score, employment history, and driving record. B. The applicant's property location, condition, and replacement cost. C. The applicant's medical history and pre-existing health conditions. D. The applicant's family history and criminal record. Answer: B. The applicant's property location, condition, and replacement cost. Explanation: in the underwriting process for homeowners insurance, the insurance company focuses on evaluating factors related to the property itself. These include the property's location, e.g., susceptibility to floods, earthquakes, condition, e.g., age of the house, maintenance and the replacement cost, how much it would cost to rebuild the house if it were damaged or destroyed. Credit scores and employment history are more relevant for personal lines like auto insurance, while medical history applies to health insurance. Question 6. Scenario-based MS. Davis is an insurance producer who is considering advertising her services. She plans to use a social media ad that guarantees potential clients the lowest premiums for homeowners insurance in the market. What issue could arise from this advertising tactic? A. MS. Davis may face disciplinary action for providing a misleading and unsubstantiated claim. B. The ad is acceptable as long as the premium is the lowest in her state. C. She must obtain written consent from the insurer before advertising the premium rates. D. The advertisement is acceptable because it includes the term guaranteed. Answer A. MS. Davis may face disciplinary action for providing a misleading and unsubstantiated claim. Explanation. Under Nevada insurance regulations, advertising must not contain misleading or unsubstantiated claims. Guaranteeing the lowest premiums without evidence to back up the claim is an example of an unfair trade practice and may result in disciplinary action against the producer. All advertising must be truthful and accurately represent the terms and conditions of the products being offered. Question 7. Which of the following is an example of indemnity in an insurance contract? A. The insured receives a cash value equal to the total premium paid over the policy's lifetime. B. The insurer reimburses the insured for a covered loss up to the policy limit, subject to the deductible. C. The insured is entitled to profit from the insurance policy payout. D. The insurer pays for the full cost of repair regardless of the policy limit. Answer B. The insurer reimburses the insured for a covered loss up to the policy limit, subject to the deductible. Explanation. Indemnity is the principle in insurance where the insured is compensated for their actual loss, but no more. The insurance company will reimburse the insured for the covered loss up to the policy limit minus any deductible, but will not pay more than the amount of the actual loss. This ensures the insured is restored to the financial position they were in before the loss, but not placed in a better position, i.e., no profit. Question 8. Which of the following statements about the underwriting process for life insurance policies in Nevada is accurate? A. The underwriting process for life insurance is based solely on the applicant's age and sex. B. The underwriting process may include reviewing the applicant's health history, lifestyle, and occupation. C. Underwriting for life insurance policies is typically completed by the insurance producer, not the insurer. D. The insurer can never deny coverage based on an applicant's health history. Answer B. The underwriting process may include reviewing the applicant's health history, lifestyle, and occupation. Explanation. In life insurance underwriting, insurers assess a variety of factors, including the applicant's health history, lifestyle, e.g., smoking, alcohol use, and occupation, e.g., dangerous jobs. These factors help determine the applicant's risk level and the appropriate premium. Age and sex are important but not the only criteria. The underwriting process is typically handled by the insurer's underwriting department, not the producer, and insurers do have the right to deny coverage based on health conditions. Question 9. Which of the following is a requirement for obtaining a Nevada insurance producer license? A. The applicant must be at least 25 years old. B. The applicant must pass a written examination administered by the Nevada Division of Insurance. C. The applicant must be a U.S. citizen. D. The applicant must have a minimum of 10 years of insurance sales experience. Answer B. The applicant must pass a written examination administered by the Nevada Division of Insurance. Explanation. To become a licensed insurance producer in Nevada, applicants must meet several criteria, including passing a written exam administered by the Nevada Division of Insurance. Age and citizenship requirements are not specified as strict criteria. The applicants must demonstrate competence in the field. Additionally, there is no experience requirement like 10 years of sales. Rather, the focus is on education and examination. Question 10. Which of the following types of insurance would be appropriate for a small business owner to protect against potential lawsuits filed by clients or customers? A. Workers' compensation insurance. B. General liability insurance. C. Homeowners insurance. D. Term life insurance. Answer B. General liability insurance. Explanation. General liability insurance is designed to protect business owners against claims of bodily injury, property damage, or personal injury that occur on the business premises or as a result of business operations. This includes lawsuits filed by clients or customers. Workers' compensation insurance covers injuries to employees, while homeowners insurance is for personal property and personal liability. Term life insurance is used to provide financial protection in the event of the insured's death, not to cover business liabilities. Question 11. Which of the following best describes him? Recurrence policy in insurance. A policy that covers claims made during the policy period, regardless of when the event occurred. B. A policy that covers claims arising from an event that occurred during the policy period, regardless of when the claim is made. C. A policy that only covers claims filed immediately after the event occurs. D. A policy that is designed to cover specific types of incidents, such as car accidents. Answer. B. A policy that covers claims arising from an event that occurred during the policy period, regardless of when the claim is made. Explanation. An occurrence policy provides coverage for claims arising from an event that happens during the policy period, even if the claim is filed after the policy has expired. This type of policy contrasts with claims-made policies, which only provide coverage for claims made during the policy period. Question 12. Which of the following is an example of a non-renewal in insurance? A. The policyholder requests to end the policy early. B. The insurer decides not to renew the policy at the end of its term due to a change in the policyholder's risk. C. The insurer agrees to extend the policy's coverage for an additional year. D. The policyholder cancels the policy midterm. Answer. B. The insurer decides not to renew the policy at the end of its term due to a change in the policyholder's risk. Explanation. Non-renewal refers to the insurer's decision not to renew policy when its term expires. This may occur if the policyholder's risk profile changes in a way that makes them less favorable for continued coverage. Unlike cancellation, non-renewal happens at the policy's expiration date and is typically initiated by the insurer. Question 13. Scenario-based. An insurance agent tells a potential client that their auto insurance policy covers damages caused by earthquakes. However, the policy explicitly excludes earthquake damage. What issue is present? A. The agent has given incorrect advice, which could result in a violation of state insurance regulations. B. The agent is allowed to provide misinformation as long as the policyholder agrees to the terms. C. The agent has successfully convinced the client to purchase a more expensive policy. D. The agent is exempt from responsibility as the policy does not mention earthquake coverage. Answer. A. The agent has given incorrect advice, which could result in a violation of state insurance regulations. Explanation. Providing incorrect information about the coverage of an insurance policy can be considered an unfair or deceptive trade practice. The agent has misrepresented the terms of the policy, which could lead to regulatory action or legal consequences. Insurance agents are required to accurately convey the terms of coverage to potential clients. Question 14. Which of the following is true regarding the financial strength rating (FSR) of an insurance company? A. An FSR guarantees that an insurer will not fail or become insolvent. B. An FSR is used to determine the company's profitability. C. An FSR is a reflection of the insurer's ability to meet its long-term obligations. D. An FSR is used to set the premiums for insurance policies. Answer. C. An FSR is a reflection of the insurer's ability to meet its long-term obligations. Explanation. The financial strength rating (FSR) evaluates an insurer's ability to meet its long-term financial obligations to policyholders. It does not guarantee that the insurer will not fail, nor does it determine premiums or profitability directly. Instead, it provides a measure of the insurer's overall financial stability. Question 15. What is a deductible in an insurance policy? A. The amount the insurer pays toward the policyholder's claim before the policyholder is required to contribute. B. The maximum amount an insurer will pay for a claim. C. The amount the policyholder must pay out of pocket before the insurer begins covering the claim. D. The premium amount the policyholder must pay for the insurance policy. Answer. C. The amount the policyholder must pay out of pocket before the insurer begins covering the claim. Explanation. A deductible is the amount the policyholder must pay out of pocket before the insurer starts paying for a covered claim. It is a form of cost sharing between the insurer and the insured. For example, if a policyholder has a $500 deductible and files a $2,000 claim, they will pay the first $500 and the insurer will cover the remaining $1,500. Question 16. Which of the following types of life insurance policies typically provides coverage for the entire life of the insured? A. Term life insurance. B. Whole life insurance. C. Universal life insurance. D. Variable life insurance. Answer: B. Whole life insurance. Explanation: whole life insurance is a type of permanent life insurance that provides coverage for the entire lifetime of the insured as long as premiums are paid. It also typically includes a savings or cash value component that grows over time. Term life insurance, on the other hand, only covers the insured for a specific term such as 10, 20, or 30 years. Question 17, scenario-based. John, a homeowner in Nevada, recently purchased a homeowner's insurance policy. He is concerned about the possibility of flooding on his property. However, the policy he purchased does not cover flood damage. What should John do? He should file a claim with his homeowner's insurance company for flood-related damages. B. John should consider purchasing a separate flood insurance policy through the National Flood Insurance Program (NFIP). C. John can rely on his homeowner's policy as it might cover flood damages due to an unforeseen event. D. John should cancel his homeowner's policy and purchase flood insurance instead. Answer: B. John should consider purchasing a separate flood insurance policy through the National Flood Insurance Program (NFIP). Explanation: homeowners' insurance policies typically exclude coverage for flood damage, so John would need to purchase a separate flood insurance policy if he is concerned about the possibility of flooding. The National Flood Insurance Program (NFIP) offers federally backed flood insurance that can be purchased separately to provide this coverage. Question 18. Which of the following is a primary responsibility of an insurance agent? A. Setting the rates for insurance policies sold by the company. B. Approving claims for insurance policies. C. Selling and servicing insurance policies to clients. D. Managing the financial investments of the insurance company. Answer: C. Selling and servicing insurance policies to clients. Explanation: insurance agents are primarily responsible for selling insurance policies, providing customer service, and assisting clients in managing their coverage needs. They do not set rates or approve claims, as those functions are typically handled by underwriters and claims adjusters within the insurance company. Question 19. What is the purpose of reinsurance? A. To provide additional funds to policyholders in the event of large claims. B. To help insurers manage risk by transferring part of their risk to another insurer. C. To guarantee that the insurer will never have to pay a claim. D. To ensure that policyholders always receive the full amount of their claim. Answer: B. To help insurers manage risk by transferring part of their risk to another insurer. Explanation: reinsurance is a practice in which an insurance company transfers a portion of its risk to another insurer, known as the reinsurer. This helps the primary insurer manage the financial risk associated with large claims or catastrophic events, ensuring that it does not have to pay out more than it can afford. Question 20. Which of the following is an example of a moral hazard in insurance? A. A person drives recklessly because they know their insurance will cover any damages. B. A person suffers an accident due to weather conditions and files a claim. C. A person files a claim for damages after an unexpected event. D. A person purchases multiple insurance policies for the same property to ensure adequate coverage. Answer: A. A person drives recklessly because they know their insurance will cover any damages. Explanation: a moral hazard occurs when a person takes on more risk because they are insulated from the consequences of that risk, often due to insurance coverage. In this example, the individual may act recklessly because they know their insurance will cover the cost of damages. This creates an increased risk for insurers. Question 21. Which of the following would be covered under a standard homeowner's insurance policy? A. Damage caused by an earthquake. B. Damage caused by a flood. C. Theft of personal property. D. Damage caused by war or terrorism. Answer: C. Theft of personal property. Explanation: the standard homeowner's insurance policy typically covers losses resulting from theft, fire, vandalism, and certain types of accidental damage. However, it does not cover damage caused by floods, earthquakes, or events such as war or terrorism, which require separate coverage or endorsements. Question 22. Which of the following is true about umbrella insurance? A. It is a type of life insurance that provides a death benefit to beneficiaries. B. It provides additional liability coverage above the limits of a policyholder's existing insurance policies. C. It is mandatory for homeowners and auto policyholders. D. It provides coverage for specific perils like fire and theft. Answer B. It provides additional liability coverage above the limits of a policyholder's existing insurance policies. Explanation: umbrella insurance provides additional liability coverage that extends beyond the limits of a person's homeowner's, auto, or other insurance policies. It offers protection in the event of major claims or lawsuits, typically covering larger amounts than what standard policies provide. Question 23. Scenario-based. Sarah has an auto insurance policy with a $1,000 deductible. After a car accident, her car sustains $5,000 in damage. How much will Sarah need to pay out of pocket? A. $1,000. B. $5,000. C. $4,000. D. $6,000. Answer A. $1,000. Explanation: Sarah's deductible is $1,000, which means she will pay the first $1,000 of the damages. After the deductible, her insurer will cover the remaining $4,000 of the $5,000 total damage. Question 24. Which of the following insurance products is designed to provide financial protection for individuals who are unable to work due to a disability? A. Life insurance. B. Health insurance. C. Disability insurance. D. Auto insurance. Answer C. Disability insurance. Explanation: disability insurance provides income replacement for individuals who are unable to work due to an illness or injury. It helps cover lost wages and other expenses during periods of disability. Life insurance provides a death benefit, while health and auto insurance provide coverage for medical and vehicle-related expenses. Question 25. What is the role of an underwriter in the insurance industry? A. To manage claims and assess damages. B. To approve or deny insurance applications based on risk assessment. C. To sell insurance policies to clients. D. To establish the premiums for insurance policies. Answer B. To approve or deny insurance applications based on risk assessment. Explanation: an underwriter evaluates the risks associated with an insurance application and determines whether the insurance company should approve or deny the coverage. Underwriters assess the applicant's risk profile and decide the terms and premiums for the policy. Question 26. Which of the following is an example of a peril typically covered under a homeowner's insurance policy? A. Damage caused by termites. B. Damage caused by earthquakes. C. Damage caused by fire. D. Damage caused by flooding. Answer C. Damage caused by fire. Explanation: homeowners insurance generally covers damage caused by fire, as fire is a covered peril under most policies. Other perils like flooding and earthquakes typically require separate policies or endorsements. Question 27. Scenario-based. Jill lives in an area prone to flooding but has not purchased flood insurance. After a heavy storm, her home is flooded, causing $10,000 in damage. How much will Jill's homeowner's policy cover? A. $10,000 because water damage is typically covered. B. $0 because flooding is excluded from standard homeowners policies. C. $5,000 because water damage is only partially covered. D. $1,000 as the deductible applies. Answer B. $0 because flooding is excluded from standard homeowners policies. Explanation: flood damage is excluded from standard homeowners insurance policies. Jill will need a separate flood insurance policy to cover the damage. Homeowners policy will not cover flood-related losses. Question 28. Which of the following best describes replacement cost in an insurance policy? A. The amount the insurer will pay after the deductible has been applied. B. The amount needed to repair or replace an item with a similar one of like kind and quality. C. The amount of money the insurer pays to the beneficiary upon death of the insured. D. The amount the insured would pay for the policy's premium. Answer B. The amount needed to repair or replace an item with a similar one of like kind and quality. Explanation: replacement cost is the amount required to replace or repair a damaged or destroyed item with one of similar kind and quality without factoring in depreciation. This is different from actual cash value, which accounts for depreciation. Question 29. Which of the following types of insurance would be most appropriate for someone who wants to ensure their income is protected if they are unable to work due to a serious illness or injury? A. Life insurance. B. Disability insurance. C. Health insurance. D. Auto insurance. Answer B. Disability insurance. Explanation. Disability insurance is specifically designed to provide income replacement if an individual becomes unable to work due to illness or injury. Life insurance provides a death benefit, while health and auto insurance cover medical and vehicle-related expenses, respectively. Question 30. Scenario-based. A tenant's property is damaged due to a fire in the building. The tenant has renter's insurance with coverage for personal property. How much will the tenant be reimbursed for the damages to their belongings? A. Full reimbursement for all damages. B. Reimbursement up to the policy's coverage limit for personal property. C. No reimbursement as fire damage is not covered. D. The tenant will need to pay the full amount of damages. Answer. B. Reimbursement up to the policy's coverage limit for personal property. Explanation. Renter's insurance typically covers personal property losses due to fire, theft, or other covered perils. The tenant will be reimbursed for the damage up to the policy's coverage limit for personal property minus any deductible.